compounding is the eighth wonder of the world. The thing in AI investing is you don't need to beat the benchmark by much. Just got to keep doing it. If I'm going to use that T20 analogy, looking at your run chase, you want that snake to be a bit better than the other one.
Having worked across the world, you people consciously took a decision to start this business in India. Why?
There's an optimism in India. Just the whole economic environment is one of growth and has been for the last few decades. The value of India in the next 5 years will double. You've got to work to justify a price in India. You've got to work hard. Nobody's willing to overpay for something.
While India might look lucrative from the outside in terms of volume, there are three Indias within India.
Interestingly, people will pay for convenience. So people will pay for the Swiggies and the Blinkits of this one. So they'll pay for convenience. So actually what you need isn't just a good product with good outcomes. You need something that's easy to use, convenient, that kind of makes it really easy to kind of engage people as well.
One of the founding members of AI, he said that when industrial revolution began, we kind of got rid of all the physical jobs that were there. AI is going to take over the intelligence job that we do. This is like the early 90s of the internet era. And it's very difficult for us to even visualize how the future is going to be like. If there are money making machines which are at your disposal, ideally the relevancy of money also goes down.
The issue with AI is not going to be with individuals, and it's even not going to be with corporates. I think it's potentially with governments. A lot of the hallucinations occur because you've got kind of bad data in the system. On the internet, there's one version of the truth, but there's multiple versions of kind of fiction. Fiction will keep growing. The truth is kind of the same. So you've got to be really careful in terms of what you feed it.
So what is that one thing which you see the Indian investors usually get wrong?
India is one of the biggest opportunities in the world right now. So much so that people who have been working and building outside India, not even native Indians, are coming to India and setting up their bases. Today in our podcast, we interview Bruce Keith, who is the co-founder of Investor.ai, which is an AI-based retail trading platform. Bruce is from the world of hedge funds and private equity and has been working in the finance space for the past 30 years. And now, after working across the world, he has now started a company which is based in India and for Indians. In this podcast, we go a little bit deeper into the world of AI and finance. We try and understand why India is such a lucrative market for everyone and how people investing are same and different at the same time. Here we go.
So first of all, thanks a lot, Bruce, for coming in. A pleasure hosting you. Bruce, I think you're one of the co-founders of Investor.ai. You started this. I mean, what's the team like? I mean, who all are the other people who are building this with you?
So Sahil, first, thank you for having me on.
Yeah.
Delighted to be here. So one of the co-founders. I'm CEO. I've got two other co-founders with me. One is based in London, Akshar Bhargava. He was previously the founding CEO of Projon, which is now Infosys BPO, and we co-founded a business together called Hedge that we sold to State Street in 2013. So we've done this rodeo before. And then our third co-founder is a chap called Sarthak Bahura. He's based in Hyderabad. He's worked in startups, but this is the first one that he's founded or co-founded. So we all kind of got together to share the same vision and have some fun trying to build it.
And your background has majorly been in finance, is what I understand, right?
Absolutely. I spent a good chunk of my career in private equity. I've spent a reasonable chunk of my career in kind of the hedge fund industry as well. I've kind of run different platforms in different countries. I've worked in Luxembourg, I've worked in the US, I've worked in the UK, and I've been in India pretty much full time for the last year. I've been coming here since 2005 on business, and it's got increased more and more and more.
You people consciously took a decision to start a business, having worked across the world. You people consciously took a decision to start this business in India. Why?
So if I think of my last business first, we spent 2 days putting the original business plan together in India, in the Oberoi in Bangalore. We kind of sat in a business meeting room with a bunch of people and kind of put it together. But that business, the clients were based in the US, were based in Japan, based in the Gulf. So there weren't ever any clients in India. So kind of starting a business from India, we'd kind of done before, but it was clients outside India. This time it's really quite different, because this time not only is the business here, but the clients are here as well. That kind of makes a massive difference, because your kind of market and product and ops are all just so much closer together and so much more intertwined. Kind of why India? I could give you, 1.4 billion reasons why. Now, the truth is, if just from a general markets perspective, not a market perspective, a markets perspective, the S&P is where you would have put your money historically. In more recent times, I would say the Nifty is as good a place. And if I think out over the next 30 years, the Nifty is a good place to put your money. So from a kind of investment perspective, it kind of stacks. And then you kind of add all the kind of demographic impacts in. You put in the what we used to call the kind of the India tech stack. You kind of add that into the mix as well, and I think you've got this really interesting mix of a fast growing dynamic, but with a kind of technology backbone that can help fintechs, wealth techs, young businesses get up and running and create product really quickly. And I think that's a kind of really interesting place to be. I think the flip side is, you can't 1.4 billion people, we're not reaching 1.4 billion people. So kind of you're trying to figure out how your market sort of fits within that, and how you can get to that, and you'll be able to crack it for a low unit economic costs or low unit price. Suddenly makes you indestructible around the rest of the world.
No, so that's exactly the point that I was gonna come to, is because while India might look lucrative from the outside in terms of volume, there are three Indias within India, and each one of these have their own behaviors. Each one of them have their own spending capacity and investment philosophies. Some are more into investments, which is a very tiny amount, and then there is a majority chunk which is into saving. And then the ARPUs are also fairly low. So we see a lot of companies from India targeting the US and the UK because there the ARPU is higher. So even if you get the volume of people lesser, the quantum of money that you make is 50, 60 times more. Again, a lot of these people are usually targeting the B2B side of things. And I think B2C signs would be fairly different. And I think since you've worked across the world, I want to understand your philosophy around this bit, because I'm sure that you people have taken this into consideration as well while you took this call.
Sure, you're right with three Indias, but not only that, you've got to work to justify a price in India. You've got to work hard. Nobody's willing to overpay for something. Okay, it's like being back in Scotland. It really is, right? No one's willing to overpay for anything. So people are very, whilst there's a lot of wealth in the country, people are very price conscious in terms of where they spend their money. So you've got to be kind of delivering value. Interestingly, people will pay for convenience. So people will pay for the Swiggies and the Blinkits of this world. So they'll pay for convenience. So actually, what you need isn't just a good product with good outcomes. You need something that's easy to use, convenient, that kind of makes it really easy to kind of engage people as well. That you've got in India is just the population age and the fact that it really is a kind of mobile first country. So unless you kind of come at it from that perspective, a younger population, mobile first. So all of those things make for kind of quite an interesting piece. And you're right, the ARPUs are lower. If I can make sure that I can make money at those ARPUs on that volume, when I go to other markets, that's so disruptive. I'm not going to go to another market to change my ARPU. I'm going to go to another market to be disruptive. Coming in as a disruptive play is a lot of fun. And I can do that with kind of India as a kind of backdrop. I think the other bit is, from an equity investing perspective, India is more like the US, in my view. Certainly more so than Europe. Europe's much more of a savings and kind of mutual fund market. India's got a lot more equity investing and trading. And in that sense, I think it's kind of closer to the US in terms of behavior. So I think if I think about the kind of products that we're developing, they're much more suited to a US context than they would be to a European context.
No, it's a very interesting point that you made, that yes, India does pay for convenience. I absolutely agree to that, and that's something which kind of trickles down to all stratas of India. It's not just this thing. I think Tier 1 and metros definitely for sure. And that's a sizable chunk. So you're basically suggesting that India is technically a test bed for you to do the stress test in terms of everything.
I'm not sure I would put it as a test bed. And look, it's so much more than that. The opportunity set's too big. Once we've got it absolutely right in India, our ability to export becomes so easy.
That's true. But from a competition perspective, because I think AI is the name of the game for the next 5 years at least, because I think this is a very interesting toy that the tech ecosystem has found, and they're now trying to play with it in whichever way we can and whichever way they can and see what fits. And I think financial sector is something which I think has been experimenting with the whole DeFi concept for some time now. And I think with blockchains and AI now in the picture as well, things look fairly interesting. So I think from a competition landscape, how are you guys placed both in India and globally?
I think the AI piece is really interesting. So let me just touch on that first and then the kind of wider question second. If we go back 25 years, actually, if we even go back to when I was at university in the 80s, back then we were writing expert systems, and everything was kind of logic and reasoning. And then, a lot of the AI that was coming out at that time was all on what's called symbolic AI. So it was all about logic and reasoning. And there was a kind of a group who started to move down the route of kind of neural networks, and the two were kind of quite separate. And neural networks is more like biology. It's trying to create something that looks more like the kind of human brain, and where it actually goes and finds its own connections. And if I look at kind of what we've got today, just AI generally as kind of as society, the whole kind of Gen AI piece is really kind of taking neural nets and really kind of bringing that to the fore and making it available for people. And I think kind of how we personally, but as organizations, use Gen AI, I think we're right at the start of that journey. If I look at my team, about 10% of our software code is written by Gen AI and 90% by humans. I would expect by the end of 25, that should be round about 75%. We should be able to get Gen AI to do a lot of the coding. Now that means the coders that I've got are now kind of reviewing and doing the exceptions and doing the more interesting stuff. But there's a whole kind of Gen AI piece. I'll give you another example. How many organizations do you know have paid licenses for, Gemini or ChatGPT or whatever kind of LLM for all their stuff? Anyone in a professional organization can kind of benefit, whether it's, using it as a creator or using it for peer analysis or using it for research. So how we use AI is going to massively transform businesses kind of over the next while. So kind of that, I think, is really exciting in terms of how we do that and how we kind of reshape businesses. That for me is kind of a backdrop. Because of that, I can almost guarantee that our competitors in 5 years' time will probably be different to our competitors today. I think there's going to be so much change kind of going on. So if I look at our kind of competitors in the investment world today, if you go to the US, 35% of the investment funds market, mutual funds market, is quant funds. So that's the kind of closest thing you've got to kind of AI. If I look at India, it's less than 1%. So if I assume that India and the US are going to kind of sort of look broadly similar, then there's 35x growth in India before you even see any market growth in terms of that kind of AI investing piece. I would love to say that we will pick up, all of that. That's not going to happen, but I'm going to do very well off the back of that. But that means there's a whole big open space for kind of other people to come into. So I think we've started to see a small number of quant funds in India. We'll start to see more, and we'll start to see more people using AI on the kind of investment side. It's not easy, but when you start to get it right, you produce really good outcomes for people, and that's kind of important.
No. So I think what you said is absolutely valid. I think the way we are using AI is going to change because AI, the technology itself, is going to change. We are right now using it for system optimization, reducing costs, increasing efficiencies within the systems, getting to know more in terms of insights of what the consumers want. There will be a time where everything, at least from a systems perspective, can basically be automated. Right?
So I'll give you an example. In my organization, we run lots of these investment products. I've got a large language model which comes out as a chatbot. Any of my team can go in and ask any question about how the performance is going, what's causing that up, down. You can actually query it using just normal language to sort of see what's going on. So in the old days, your sales guy would have phoned your product guy or emailed or whatever, but there would have been a kind of, now they can go in directly and they can ask these questions. So you can still go to the product guy, but you go to the product guy and say, this has happened. This is what I think based, the LLM, or just this is what I think. Do you agree? So you suddenly, you've just taken out the amount of time it took two people to find time in each other's calendars and get together and explain it and go through it. And you've just changed that whole dynamic, which means you're, again, your sales guy facing off to kind of channel our customers. Now we're in the process of taking that current large language model, that chatbot, and exposing it to customers. So now it won't just be my team. You want to go in and find out what's going on. So you just, your ability to kind of change that, and I love it. You go in, and I know it's the same with kind of with Gen AI generally, but you mistype something. It knows broadly what you mean. It's kind of predicting the question that you're going to be asking. Sometimes the answers are not great, but generally, I would say, generally the answers, if you can get your prompts right, generally the answers are good.
No, so I think AI is at a very, very infant stage. I mean, we can't even begin to imagine what this thing is going to be like, because this is like the early 90s of the internet era. And it's very difficult for us to even visualize how the future is going to be like. I wanted to jump into the AI versus Gen AI bit, but I want to make one point before I get into it. And this is something which has been eating my brain for some time, is we hopefully, realistically, I think in the next 10 to 15 years, we will be at a stage where humans will ideally will not even need to raise a finger to do anything. And because even now, there are people who are writing prompts for Gen AIs to create a business plan out of $100 and convert it into $1 million, and then getting AIs to execute it, where AIs are making the calls, taking the bets, having the chat, and basically doing the whole ops bit as well. And the money is just getting deposited in your account. This whole thing eventually, and I believe any technology which is being born right now out of AI will eventually become a feature in a bigger scheme of things. And those things will become commoditized in some form or the other, because they will be a part of a bigger picture, a bigger thing which is being accomplished. I'm scared to even think about it, but if there are money making machines which are at your disposal, ideally the relevancy of money also goes down in some form. This whole idea of human basic income or something, giving people money, X amount of money per month for survival, and let them do whatever they want them to do, is an utopian concept which might have some feats on the in reality in the future. What is your take on this bit?
First, it's a massive question. I must admit, I kind of really enjoyed debating it because I can kind of swing several ways around it. So kind of one thing, if I compare kind of humans to AI, and by AI I mean Gen AI or neural networks specifically. As humans, what we're really good at making an inference or a decision or drawing a conclusion on very little data. Whereas actually AI needs lots of data. So AI works well when it's got lots of data. So it's the idiot savant. So give it lots of data and ask it questions. It will outperform you or I every day of the week. That instinctive thing that we have with very little data and being able to kind of get to conclusions on that, and a little bit of that is gut feel or whatever we want to call it. We kind of we'll always have a little bit of an edge there. Now, kind of how that will change over time, I don't know. And you're right about the kind of 90s in the internet, because I was in kind of private equity and venture capital at that time, and you could all the business plans that used to hit your desk in the kind of late 90s, and what this thing was going to do and all the rest of it. And there was lots of ideas, but I don't think any of us kind of really understood it and the kind of implications and mobile tech and everything else that's kind of gone around that. So I think that's, for me, the kind of analogy on what does it mean for us. I said I started working in India in 2005. We'd been through kind of Y2K. The India tech industry had already kind of really risen internationally off the back of that, and we were in the kind of early stages of kind of BPO offshoring, so kind of white collar professional work offshoring. There was kind of KPO, kind of the knowledge process outsourcing going on at that time, and it was creating lots of jobs and opportunities in India, but it was having the opposite effect in a European context. And I was kind of going around lots of companies saying, listen, we can improve your kind of speed, all of these different things at a kind of lower cost. I was having the same discussion back then. So what does that mean for us? What does that mean for our kids? jobs are people going to do? And a lot of jobs did move, but that didn't result in kind of massive unemployment. It meant that the roles that were there changed, and people had to be, become more creative or take on a step up and take on a kind of different role that was kind of potentially kind of higher or more creative than that. So I think overall kind of produced a good outcome. I think what we're looking at with AI is something similar, but we're not displacing it to different countries. We're displacing it to this in the corner. And I think, as humans, we kind of sort of struggle with that and kind of where does the kind of end point get to? So I think there's a kind of, for me, the kind of, will jobs continue to exist? Yes, they will. I also think certain people need to get up in the morning and work. Whether AI writes a business plan for you or not, they kind of have to get up and do it, I think I would struggle if I didn't have something like that to do. So I think there is a bit of, it's part of kind of what we are. I think we'll have to find the right stuff to do, and it might be different, but whatever you were doing at the start of your career and what you're doing today is different, and it'll keep morphing and changing beyond that.
That's absolutely true. I remember somebody saying this, I think one of the founding members of AI, he said that we are at a start. So the way when industrial revolution began, we kind of got rid of all the physical jobs that were there. The pulling bit and creation of machines. So machines basically kind of replaced the whole physical work that we used to do. AI is going to take over the intelligence job that we do. And it's true, when they say that technology is a great servant but a terrible master. I think it'll be a good assistant for sure for the majority of the time that we are there in existence in this world. But then that brings me the question of Gen AI and singularity in general. Because you people are dealing with AI, and currently, even now, I know people because I have friends who basically develop these bots and they work on the LLMs and all. AI is at a very shitty stage when it comes to executing on ground right now. Even now, there's a lot of hand holding which needs to be done. But there has been this hoopla, this hype, which has been created around singularity. Some might call it a PR stunt just to get the hype going. And there are bigger people who have been saying that Gen AI has been achieved, singularity. And of course, all of this sounds really a popcorn drama kind of thing, which is unfolding, where a new supervillain is being created right now. But what's your take of this on this whole Gen AI? In fact, for our viewers, if you can also help us explain the difference between AI and Gen AI, and then we can probably get down to it.
Okay. Yeah. So look, if you go back from a research perspective, actually you kind of need to go back to the 80s. But I wasn't involved in this at that time. But at that point, AI was what we call symbolic AI. So it was all about you would program logic and reasoning into the machine. So, in simple terms, a kind of if then else type statement, but lots and lots and lots. So that's how people kind of thought of it. So, the mind maps that we used to draw back then were very much a kind of logic and reasoning. The kind of other school of thought was the kind of neural nets thought. And what they were trying to do was they were trying to kind of recreate the human brain. So it was much more about, it looks more like biology. And in the human brain, it's about different connections kind of firing to each other. So when you think about Gen AI, so much of it is about kind of how you pre-train and you've got to let the machine make its own connections. So when you set something up, what you're trying to do is the kind of rough output you want. You want to throw it all of the inputs and you want to tell it what shape of output you want. And then it will go and make the connections to get there. Now it's quite difficult to be able to explain how it did that. So you've got to be able to kind of ask it lots of different things to sort of see it. But ultimately you're trying to kind of mimic the brain. Then trick is up front. The trick's two or three tricks, but one of the tricks is you've got to know what question to ask it. So we're in the investment world. The wrong question to ask it is how do I make the most returns? The right question to ask it is how can I invest money and grow and not lose money? And then actually as a kind of side output. So sometimes you've got to ask a slightly different question to get the kind of output you want. So one is, that's the kind of why variable people talk about. It's about what you're training it to do. Second thing is about the kind of data you feed it. And a lot of the hallucinations occur because you've got kind of bad data in the system. And then machines creating more bad data off kind of bad data. And on the internet, there's one version of the truth, but there's multiple versions of kind of fiction. The fiction will keep growing. The truth is kind of the same. So you've got to be really careful in terms of what you feed it. So we spend a lot of time on the kind of data that we're kind of feeding into our models. So that kind of Gen AI piece, if you're not tight on kind of data in, no, you're not asking it the right questions, then how you kind of train that and sort of pull that together, the output will be less useful, or it will answer one question well, but kind of other questions kind of less well. I think we've kind of on down that route to some of the kind of use cases that you've got. So there's a lot of good out there. I'd like to think what we're doing is kind of helping people, but equally there's, I think that the issue with AI is not going to be with individuals, and it's even not going to be with corporates, even though there's some kind of horrible supervillains out there in the kind of Lex Luthor style. I think it's potentially with governments. Governments that, if I think about so many things over kind of, things as in inventions over the last kind of 50 years, actually there's been some element of government, public, quite often defense money that's going into the kind of initial research to get up and running. I think where AI becomes a little bit scary is where governments start to use it for their kind of own, quote unquote international agendas. And I'm not sure there's kind of good or bad governments out there. I think frankly they're all a little bit on the kind of shady side when it kind of comes down to it. And whether you're using AI to, I don't know, help on social media to kind of prompt something, or whether you're using AI to improve your kind of weapons efficiency, and that kind of keeps going. I think that for me is that problems on AI are going to come down those routes rather than for corporates fundamentally want to make money, whether they say otherwise or not, and individuals want to make their lives better. So the kind of two things there are fine. I think governments are going to be ultimately the problem.
No, I absolutely agree. I think eventually, no matter how good a technology is, if it gets regulated, if the industry gets regulated, or if there are clauses which come into play that, hey, you can't do this, then things change. There are so many examples of similar stuff happening,
Yeah.
right from gaming to blockchain in India, very frankly.
The problem is in India, so government regulates AI in India. So that can protect the consumer, but that doesn't have any impact on what the US does with its AI industry, or China does, or Russia does, or, name any country, frankly, globally, in terms of how they use it. So I think that there is a kind of international, almost Geneva Conventions type component in here. I heard recently someone talking about AI being used for smart minefields. So once a mine had gone off, how the other mines would move together to fill up the gap. That's horrible. That's really horrible, isn't it? So there's some quite insidious things that you could easily kind of pull together. Equally, I think there's so much good out there that we can do with it. We've got to kind of get focused on that. But as I say, for me, the issue is more at that kind of government level than at a kind of corporate or individual level.
No, I completely understand. I understand where you're coming from as well. Now I want to get into the finance bit of thing,
Oh,
which
excellent.
is basically what you guys have been up to. So I'm a retail investor. I started investing around 4 5 years back. I have somebody who manages my portfolio, which is at least the ones which have a certain amount of asset and above usually have somebody else
Yeah.
manage their portfolios. Your product is primarily focused to retail investors. You people use AI to kind of create these packets, right? So which help them basically AI powered equity investments, and you people help them power the stock recommendations using AI. If I am not managing my portfolio and if somebody else is, then isn't your main TG the broker?
There was a Credit Suisse report came out a couple of years ago. They do a kind of annual, when Credit Suisse was still Credit Suisse, they did an annual report on the wealth management industry globally. And the number it quoted was there was 2.1 billion people globally who have enough money, enough liquid assets to be advised. And there's 50 million people who are advised. So that means there's 2.05 billion people who have money that could be advised that aren't. Now, some of that could be that it's not enough money for it to make sense for an advisor. So it might fit that Credit Suisse definition, but it doesn't, if an advisor can only advise 20 people, 50, 100 people, he's going to cut it based on size because he'll make more money there. So
Mm.
it could be down to that. It could be because I don't have an advisor. It could be because they want to do it themselves. I might be in my 50s, but I'm very much in the kind of DIY camp when it comes to doing your own thing. And then there's a whole load of people where they kind of don't know what to do, so they'll put it in mutual funds or they'll put it in some kind of savings product. What we want to do is we want to help that 2 billion people, but starting with a kind of lesser number in India, a few hundred million people who aren't necessarily advised just because they can't afford it, or more importantly, because they want to do it themselves. And there's quite a cadre that sort of fall in that camp. And if you want to do it yourself, well, we can help you with that. And no one needs more stock recommendations, right? Because you go on a WhatsApp, well, it doesn't matter what WhatsApp group you're on. You can go on any WhatsApp group, and even your family WhatsApp group, go on it. Has anyone got a good stock recommendation? You'll get a stock recommendation, right? So stock recommendations are everywhere. From a UK context, you would go down the pub. Someone's going to give you one. So they're just, family dinner, whatever it happens to be. So everyone will tell you something to buy. Nobody will tell you when to sell it. Actually, you go and buy something, and it might do that. So if you're lucky, you spoke to the right person, it might do that. But at some point, it'll probably go then do that. And then when you get back around to looking at it again, you've kind of missed the window. So part of it is about being systematic. So part of it is if you don't have the discipline to kind of look at that every day, and most people don't, how do you create a system that does that for you and actually says to you, right, now it's time to rebalance. Now it's time to get out of those 4 or 5 and buy these ones. So it's creating that kind of systematic investing. And I don't think it should be your whole portfolio. So if I look at my own portfolio, roughly 50% of my portfolio is in ETFs. It's kind of general market exposure or sector exposures, some commodity in there, but it's my big long-term calls. So I've got a whole lot of Nifty, I've got a whole lot of S&P. I'll just have my kind of big long-term ones in there. I've then got about 20%, which are kind of interesting stocks that I like. And I buy it because I might have some affiliation towards that market or that product, or it's a yield. I'm not Warren Buffett, but the way that Warren Buffett does, he makes a choice about a stock, goes and buys it, right? So, that kind of long-term sort of, fundamentals kind of buy and hold piece. And then I've got about 30% of my portfolio systematic. And that's the bit that needs to kind of keep trading. And that's where I use AI in my portfolio. So it's not the whole, but it plays an important role in that. It's not enough to tell someone buy this. You've also got to tell them sell and buy this. And what you don't want people to do, if you sell and stay out of the market, being out of the market's a bad thing. So if I was to draw an analogy for an Indian audience, I'd say investing is a test match. You've got to be in, and you're playing for the full amount of time. Trading's T20. Trading, you're kind of in, and it's intense, but it's kind of short term. What AI can do is it can take that T20 and make it last for as long as a test match, because it will just keep going and going, because it never tires, keeps going and going and going and going and going. So it's applying T20 to test match. So it's right for part of your portfolio.
Interesting. And how long have you guys been operating in India now?
So we started the business in 2018. We spent a good chunk of time developing the AI and kind of creating the platform and pulling that together. Our first kind of investment product went live during the kind of early part of what we've got here is just round about kind of COVID time, just before COVID, so round about then. And then it's been kind of developing since that point.
Interesting. So, what is that one thing which you see the Indian investors usually get wrong majority of the times?
I tell you what it is. It's when you've been in a market that's been growing for so long. Sometimes the market will take a turn. It has done in the last sort of few weeks, months. Sometimes that means that you're going to sell out of some positions for a loss and buy some other ones. And actually, if you look at it over the longer term, that would have been the right thing to do. I would say that when I look at kind of Indian investors, because everyone believes in the longer term piece, rather than selling for a loss, quite often they'd rather stay in and hold it and wait till it comes back and makes them money. Now, it might do that. It might come back and make some money, but you've lost the opportunity cost of grabbing those other things. We've got investment baskets, model portfolios that rebalance every 2 weeks, every 4 weeks. If you don't follow the rebalance, you'll actually miss all of the kind of good ideas that keep coming through. So sometimes you've just got to take those losses and believe in the process and believe that T20 battler is going to keep going, and that but in that kind of test match environment. So I think that unwillingness to crystallize a loss is probably the biggest kind of psychological thing that I see Indian investors doing, which I wish they wouldn't do.
But isn't this true for all investors across the globe?
It is, but I think there's an optimism in India, right? There's you kind of we're in a market where things are going up. Now, where the stock market may or may not go up, but generally, just the whole economic environment is one of growth and has been for the last few decades. So kind of within that context, there's an optimism that comes with that. So if you're in that optimistic context, whereas honestly, if I go back to the UK or I'm in Europe, that level of optimism isn't there. So people will take a loss because they don't feel that they're necessarily going to see that thing. So I think it's more pronounced in India just because of the kind of general economic environment and journey that the country's on.
They want to win all the small battles as well.
And you do. Look, the thing with systematic investing, AI investing, is you don't need to beat the benchmark by much. Just got to keep doing it. It's again, if I'm going to use that T20 analogy, looking at your run chase, you want that snake to be a bit better than the other one. If the other one's the benchmark, if you're a bit better and you keep doing a bit better every time, the jaws just open up.
And what is a realistic number in terms of ROI that any investor should look at a certain horizon? And how do you think this bringing AI into the picture is going to optimize for that? Or is it going to be the same only?
I think it kind of depends country to country because it depends where your kind of inflation rate is at and your savings rate is at and kind of risk. I think we will see some kind of tough months ahead. I think globally there's some big headwinds on the horizon, so we will see some kind of negative pieces coming on. So I think you can't look at it over a kind of 1 year period. You've got to kind of look at it over a kind of broader horizon. If I were sitting in the UK, I would say, look, inflation's running at about 5%, savings rates at about kind of 4.5%. So, you want to be making anything north of kind of 8 or 9 feels like a kind of good place to be. I'm sitting in India, and those numbers are kind of quite different, right? If your market can deliver 25-30%, that's going to be your kind of benchmark that you need to be doing better than. So your AI is going to do better than that. So, a lot of it kind of sort of starts from there. So kind of, again, if I take an India context, India's like a private equity investment. The value of India in the next 5 years will double, right? That's just by my PE days, value a company. If you could get the actual overarching value to double in that kind of 5 year period, that was a good private equity. India right now feels like that. It's that kind of growth. So if you can see it, the overall value kind of doubling in 5 years, you've got to be doing at least, and that's just general piece, you've got to be doing at least that. Plus, you would expect if you're in equities to be getting a premium on that as well. So I've not answered your question straight because I'm not sure there's an easy answer to it. I'm trying to point around.
So basically, usually people say that in a 10 to 20-year horizon period, an average investor usually makes, after, doing the pluses and the minuses, around 18 to 20% is a good number if you get an ROI.
Honestly, yeah, if you're doing 15%, that's kind of good, but it kind of depends what your interest rate is. Your interest rate's 8%, 15% is good. If your interest rate, as I say, back in a UK context, interest rate's 4%, 4.5%, getting 9% is good.
So it's the delta. It's always the delta.
Absolutely. And look, when I was growing up, you couldn't access equity markets unless you had a certain amount of money or you came from the right background, which I had neither. So you were taught to save. You grew up and you were taught to put money away and save. And it's only, later in life when you realize that inflation kills savings. And once that particular penny drops, then you've got to find a way to kind of be in markets, whether it's through mutual funds or whether it's directly, kind of that's down to the individual and their own appetite. You really have, if you rely on savings or fixed deposits, you're never going to beat inflation.
Interesting. That's a very interesting way to look at things. That's a valid point. I also want to understand from you. So you come from a PE background, right? And of course, if you've seen the complete spectrum in terms of investments, if I say you had 100 rupees to invest as a PE and 100 rupees as a retail investor, how does these two strategies differ?
So let me do P, and let me, 'cause I've been in the hedge world as well. Let me do hedge, and
Hmm.
let me do kind of individual. So the thing with a
What's the
P,
difference between hedge and PE?
yeah, okay. So P, first of all, is always going to be in an unlisted stock. You're buying into a company where your ability to sell it again and get liquidity is constrained. So it needs a whole number of things to kind of come together. So you buy in a company that is not on the market. You either hope it goes to the market or someone else buys it. That's the kind of P piece. So as a consequence of that, one of the most important things in P is having dry powder, having cash. So when that opportunity comes along, you can go and do it. So a P fund will be very selective in terms of how it deploys its capital. A P fund will never put more than 10% of its capital into one investment. It will always make sure, and if it's an investment where it thinks there's going to be follow-on money, so it's going to be doing an acquisition or something else where it needs to put more money in, it'll be less than 10%, so it can go up to 10%. So generally, a PE fund, just globally, wouldn't invest more than 10% in one asset. It'll assume it's going to have to hold it for somewhere around kind of probably about 4 years. So therefore, kind of within that, you start to sort of that's where you get your kind of double your money kind of piece from. And then you've got to try and work out how you add value to it along the way, whether it's acquisitions, whether you have to bring in new management, launch new products. So, you'll use leverage, you'll use lots of different things within that. But one of the big bits is you will use leverage. So if the value of the business has doubled in 5 years, through the use of leverage, your equity value will be going up more than that because you'll have paid back some of the leverage. So that's my kind of private equity. So private equity uses leverage well. It buys on fundamentals. It's quite happy to let opportunities go past because it will only pick the one that it thinks it can do best with. And also in private equity, because your ability to get out is hard, there's an old expression which is, no one got sacked for selling at a profit. So in private equity, you make a gain, you bank it, you move on. It doesn't matter if the next guy does better than you. You don't have to take everything off the table. You just have to move on. Hedge is slightly different. In a hedge fund, you would expect some element of kind of everything's up, not everything. Generally, most things are liquid and on the market. The hedge fund will take positions. So, like private equity, it will take a position. So, I'll have a view on something and take a position, but it will hedge against that. So, you might take a position on a stock like Infosys and say, I'm either going long or short on Infosys for whatever reason. But what I don't want to do is I don't want to be impacted by general tech environment. So as a contract, I'll take a reverse position on the tech sector. So the hedge fund is then focused on the idea that it's got, and it's trying to hedge out all the other risks along the way. The difference between hedge and private equity, so there's a lot of the same thinking in terms of taking positions. The big difference is a hedge fund has to keep investing. It must be invested the whole time. So again, it'll use leverage, but it must be investing the whole time. So for a hedge fund to not be in the market is kind of a bad thing to be. So that too, in that sense, so it's always looking for that next idea. So if I then get to the individual, I think as an individual, there's some elements of kind of both kind of come into play. So firstly, you've got to be invested. I say it to my kids, if you've got money that you're going to put into some kind of investment savings pot, put it in and invest it. Don't put it in and leave it in some kind of cash or cash equivalent. You've got to invest it. Using that test match analogy, invest it and invest it for the long term. It doesn't matter how you do it, but you must be invested. Being in cash is bad because you're not going to beat inflation again. So that you're closer to hedge in that sense. I actually think as a kind of individual investor, some of the kind of private equity disciplines, whether that's around diversification, not having more than 10% in one thing, or being really clear why you're buying something and kind of going and buying that, I think that's a kind of a good thing. I think the other bit from a retail investor perspective, hedge funds are very good at kind of churning that book. I think as a retail investor, you should have some of your book which you just leave and you let it run, and some that you churn. So therefore, having some rules around that and kind of making that work, whatever those rules are, you've got to kind of go and apply them. So I think those are the differences. So in terms of firstly, a private equity person wouldn't get out of bed for 100 rupees. So let's make it a crore. Let's get it 10 crore. Let's make it more interesting, right? Let's make 10 crore. Our 10 crore investment, our private equity guy will sit there and be very particular, and he'll prod whatever comes in until he finds the right one and kind of goes for it. Our hedge guy will invest it almost immediately and we'll keep it invested. So your individual, I think, needs to be invested. Doesn't matter that you invest it all on day one, but invest it quite quickly over a period. If you don't know what you're doing, invest in the market. I'm a big fan of, if you're not sure what you're doing, get an ETF that covers the market as a whole and do that. If you've got a view on a sector, buy some sector ETFs. If I think about my exposure in the US, you can actually buy reverse ETFs in the US, which allows you to short a sector. So you can kind of go long or short on a sector. So that would be where I would go. And buy something you know something about. Right? If you don't understand tech, you don't need to be in tech. If you understand consumer goods and you can see what's going on in the shelf space in shops and what people are interested in, that's okay, right? Find something that kind of interests you because you're more likely to understand some of the dynamics and what's going on. Invest in something because someone told you about it, and if you don't know what they do, don't do it. If you can't explain it to your partner,
Yeah.
don't do it.
This holds true in any kind of investments, even in the venture side is the same thing. If you don't understand a domain, don't invest in that company. Even if your friends tell you, if you don't get it,
Especially if your
don't do
friends
it.
tell you, if you can't spot the idiot at the table, it's you.
Yeah, absolutely. Absolutely. SIPs versus ETF. What's
I
your
think
take?
they're just different things, aren't they?
No, sorry,
You
SIP,
know,
sorry. Mutual funds versus ETF.
ETF every day.
Why?
Let me tell you why. That's because I'm a DIY investor. So as a
Ah,
DIY investor, I have a strong view on what I want. An ETF delivers that in a cost-efficient way, and it gives me instant liquidity. So I love it. But if you don't know what you want, then mutual fund is the right answer. So,
mm,
if actually, I'll give you an example of, so my daughter said to me, kind of, what should I do? And she was looking at different options. And I said, well, what are you interested in? And we kind of narrowed it down. She said, I still don't know what to do. So we found a kind of fund that specialized in that. So let them do it. And it's like, fine. So kind of decide what you want and let them do it. Obviously, you're not going to do quant investing on your own. So if you want some quant exposure, you're going to have it in a fund. Honestly, if you want Nifty exposure or S&P exposure or FTSE exposure, all of mine's in ETFs.
interesting. Have you read this book called The Richest Man in Babylon?
No, I haven't.
Oh, it's a very thin book and basically is considered to be one of the best books in finance. And it's been there, it's one of the classics. You can buy it off Amazon for $100. It's that cheap because the older books are always cheaper to buy, right? So this book basically talks about the philosophy of how to manage finances. It talks in a parable format where it's a story of the richest man in Babylon. It basically talks about this guy who found a manuscript of people who are in Babylon. And this was an archaeologist guy who basically wrote the book. And that manuscript basically documents the teachings of one of the richest mans in Babylon about finances. And the whole concept is very, very, very simple. Of the 100% of the money that you have, break it down into 10, 20, 70. That's it. 10, 20, 70. 10% savings, 20% investments, 70% is expense. And whatever money, even if you get 10 rupees, do it with this. And you will be rich. That's it. That's the simple, basic mathematics.
And the truth is, compounding is the eighth wonder of the world.
Yes,
And
absolutely.
again, I talked about savings earlier and being in my 20s and thinking that saving was a good thing. Honestly, if I'd been putting money in the S&P at that time, and
Yeah.
you're right, it didn't need to be much every month. What a difference. So actually teaching that to the next generation is a really important thing. You mentioned SIP earlier, but SIP is a great thing. If you just get people putting a little bit away. Personally, I stick it in an ETF. I don't care what you stick in. Stick in something that's invested. Don't think of it as your side hustle. Just
Yeah.
put it away. Put
Yeah.
it away and
And
let it build.
and you also talked about this that you shouldn't just let the money rot. The book also
Oh,
talks about this. You should not let the money rot. Invest. That money should make money for you. As
yeah.
simple as that.
I think there's one other thing as well, and this is maybe personal, but I remember when we started first business, and there was a kind of period at the kind of early stage there. It was really tough. We'd burned through so much of my own personal resources. We were going, at a personal level. We were kind of getting down to kind of bare cupboards type stuff. But before we had kind of got to that, and we got fundraising, and it all came good. But there was a period where we were just kind of it was just burning down. And what my wife did She sat down, she's an accountant by training. So she sat down with a spreadsheet and she's just set out, right, what do we need to live? And what do we need to live this quality of life, this quality and this quality? She mapped it out. And suddenly, knowing what the number is that you need to live for this quality of life, or the next one or the one below, just knowing that number is actually quite liberating. Then as you invest, so I'm now, I'm now at the other end of my life, but as you knowing actually if I've got through my investments, if I can generate an annual income of X and inflation adjusted, obviously, that is enough to keep me in that sort of same quality. That's it's just quite an interesting exercise. So you don't have to be the richest man in Babylon. You're as rich as you need to be to live the
Yeah.
life you want to live.
Absolutely. I think this has been a pleasure. We will now move on to the last segment, which is you as a foreigner working in India. I think you've spent more than 2 decades working in this industry, and also you've spent some time in India before, but this is probably the first time where you're working hands-on with your customer base in India as well. How's the experience been? How's the weather been? How's the culture been for you? And we'll probably start with the weather. I think you're in Bombay, which is one of the most sweltering, humid places in India, and you come from London.
Yeah, worse than that, I come from Scotland. So when you come from Scotland, I was speaking to my parents at the weekend, and it's snowing,
Yeah.
and I'm complaining because my aircon's not pumping enough cold air out. So no, it is different. I said to someone the other day, I'm an AI, and they said, "What do you mean?" I said, "Well, an NRI is a non-resident Indian, an AI is an accidental Indian. So I'm an accidental Indian. I'm an AI." So what's it like? So firstly, I love it. I've been here now for 12 months. So I'm I'm into my kind of second year here and, just moved to a new apartment. So I'm loving that. It is different. It's when I go back to the UK, again, that kind of optimism is just so different. So there's something about the kind of whole environment and how that kind of impacts all of us. A lot of the business stuff's the same. I've worked in Switzerland, I've worked in Germany, Luxembourg, I've worked in the US, worked in the UK. I've worked kind of all over the place. Ultimately, business is about people, and it's about how you kind of get on with people and how you can influence them and how they influence you and how, the kind of outcomes that you get from that. So whilst on the surface, there's kind of lots of difference. Actually, once you kind of go behind that, there really isn't. And, wherever you are in the world, you get attracted to spend time with people that share the same values as you. So
Yeah.
I do think, that you've got over 1 billion people, it's much easier to find people that kind of are similar to you in that regard. So kind of all of that is kind of straightforward. Every country's got its quirks. And it took me the hardest thing that I found was finding a regular game of football. So whilst I gave you a cricket analogy earlier, Scotland doesn't play cricket. Right? We play football. It took me ages to find one. I've now found one. And the irony is the team that I play for is called Scottish Strikers. And I'm the only Scottish person there. So slightly ironic. But so the stuff like that's different. But it's it's a lot of fun. If someone said to me, actually, if my kids, there we go. Here's the acid test. If my kids said to me, "I've got a job in Mumbai, Bangalore, kind of wherever," I would say go for it. I'd say absolutely go for it. That's how I feel about it.
Mm,
To your point about the weather, whatever city you're in thinks they've got better weather than the city you live in. So when I'm
mm.
in Bangalore, they say, "Oh, you must prefer the climate here than in Mumbai." So wherever you are in the country, you're in
Yeah.
Kent, everyone, in Kochi, everyone says so. Wherever you are, that's kind of where it kind of comes out, I think.
I think I have stayed in Bombay for 7 years. I consider the work ethic of the people there the best in India. It's amazing working with them. I mean, especially people who are workaholics. They love Bombay because everybody is just running around all the time. It starts at 4, it doesn't end. But of course, if your office is not an air on, which I think for a finance guy, you don't have to travel much. Yeah. Your life is fairly simpler. Guys like us, we have done the hard stuff there in Bombay, and the weather is not forgiving. But then, well, that's
Yeah,
the only
well,
thing which,
yeah, you're right. In the summer months, it's sweltering,
yeah,
but right now,
yeah,
this time of year is beautiful.
yeah.
So
Which
enjoy it now through till kind of February, March time.
which part of Bombay do you stay in?
I stay in Bandra.
You stay in Bandra.
I
Bandra
used
West,
to
Bandra
stay,
East.
Yeah, I used Bandra West. I used to stay in Sion, and I now stay in Bandra West. So just there's,
But your
wants to
office is
do.
in BKC?
No, offices in Andheri.
Then you travel every day from Bandra to Andheri. That's
Yeah,
the other side. So I think you'll
yeah,
find
it's okay.
relatively lesser
No,
traffic.
it's not too bad. Look, when I worked in London, I was trying. That is one of the big differences. When I worked in London, I would either get the underground or I would cycle. If I was going to be in the office all day, I would cycle. I
Mm.
would get the underground. I'm never going to get on a bike in Mumbai because I'm too scared. Right? Let's
Yeah,
just get that up
I
front.
agree.
And I know we've opened the first bit in terms of the kind of mass transit system, but that's still to kind of get built out. So kind of getting in a car all the time or getting in an auto, that to travel kind of some of those distances, that is kind of slightly unusual to me compared to what I would be doing if I was back in the UK.
A few foreigners that I know of have very weirdly and surprisingly, counterintuitively, have said that our lives in India are much more simpler, or rather much more easier to live rather than when we were living back in the country. One is probably definitely the laws are a little bit more liberal for the common man. Secondly, I think technology wise, the way things function here are much, much, much more advanced than the other parts of the world that you go off, and which I think Indians don't realize this, how lucky they are to have a UPI system and a 10-minute delivery at your doorstep. But these are things which are magical for people who are coming from abroad. What do you think about that?
I'm going to give you two perspectives. So I think I agree with half of what you said. So the service culture is such that you'll have a maid, or there'll be lots of people that can do all of those things. So that's brilliant. So that instantly is fantastic. On the tech stuff, whether it's kind of UPI or GPay or kind of ARDA or KYC, all of those are great unless you're not Indian. So actually getting a bank account and being, you need to get a bank account to be able to use UPI. So actually there's like
Oh,
as an outsider coming in, it's actually harder to get started on that than
mm.
if you kind of start from the inside. So I'm kind of going through that kind of journey just now. But yeah, at the end of football, I play football a couple of times a week. At the end of a football game, everyone's just kind of, QR code in UPI in it or GPay in it. And I'm the one guy with cash because that's the only way that I can kind of pay for my share.
You have to bribe your mate to give you a bank account now.
I have started the process. It'll just take a wee bit of time.
Great, great. What about food? Are you a foodie, Bruce?
So one of the benefits of being in Mumbai is just sheer variety.
Yeah.
I think that's one of the best bits about Mumbai is that kind of nightlife, entertainment, food, drink, all of that piece. So, just in a short walk from my apartment, there's kind of so many different kind of varieties around. So I kind of love that. If you want Thai, if you want, obviously there's all kind of different kind of Indian
Yeah.
regional cooking, but there's a Persian restaurant. Actually, there's even a European restaurant beside. So it's all in such kind of close proximity, and the ingredients are so fresh.
Yeah.
So, the kind of dealing with kind of fresh ingredients and fresh spices, and just kind of the variety is kind of is brilliant.
You got any Delhi belly incidents happening to you in Bombay?
Now and again,
No, I think a lot of people, the smell, I think Bombay has a very distinct smell, don't you think? Just when you get down the flight, it hits you. Then you get used to it.
yeah,
So,
maybe I just don't notice it anymore. Maybe it's just
ah,
a part and parcel.
yeah, it's the fish. These are the fishes.
Well, I was going to say, yeah, yeah, being in Bandra in the summer, then that'll
Yeah.
that'll
Oh yeah,
sell
you're
me.
also in Bandra, so then to you'll get a fresh whiff.
When the wind will go in the right way or the wrong way.
Great. I think, Bruce, with that, we are towards the end of the podcast. I have had a great experience. I think this was a very open discussion around AI, finance, as well as your life here in India. But I think very, very educational, very basic, but at the same time, very comprehensive. How was your experience, Bruce?
So yeah, I've loved it. I've sometimes wondered kind of where the questions were going to go, which is always kind of quite interesting. So you've kind of kept me on my toes, but it's been really really enjoyable. I think we've covered a lot of ground from test match in T20 through to, singularities. So, there's a lot in that. So hopefully your viewers and listeners enjoy it and can get something from it.
Before we go, Bruce, why don't you give us a little bit of lowdown about Investor.ai, what it does, and how it can benefit our community and the viewers,
So
and where can they access it and how?
So listen, Investor.ai, our business, I love it. It does that systematic investing. The AI does all the hard work for you. And what does that mean? That means you pay a subscription, then it doesn't matter how much you invest, as little or as much as you want after that. And that gives you access to different subscriptions for different model portfolios. So you pick the one that suits you, you invest, and then the machine will tell you when to kind of rebalance, when to kind of sell and buy again. And it works for portfolios that you want to rebalance every 2 weeks, 4 weeks, 2 months. It works for intraday portfolios. It works across a kind of whole spectrum, kind of suitable investment things. The AI is done brilliantly. If you look at it, talk about kind of the specific results, but generally it's on a 12-month period does double what the market does, or at least it has done. It can't guarantee that going forward. So, that consistently just winning by a little bit is enough for it to kind of to really produce sort of super returns. We're not B2C in the kind of strict sense of the word. We work B2B2C. So if you want our product, you've got to go through one of our partners. So you go to HDFC or you go to GeoJet or Axis or Yes Securities or LKP, BNRATI, Anand Rathi. You kind of multiple brokers that you go to, and you'll find us on there. And kind of you should be able to access it once you've paid your subscription. You should be able to access it with one click. And importantly, when you want to get out, when you want to exit, clear off, or you want to rebalance, you should be able to do that on one click as well. That convenience piece that we talked about early on is kind of really important. So that delivery that you can sell 10 stocks and buy 10 stocks, you should be able to. So it made it really, really easy for people. So it's all about systematic investing. It's all about using AI to kind of crunch the literally 1.5 trillion data points every day.
Interesting. So B2B2C is something which is fairly interesting. Is this the initial part of your GTM that you people are partnering up with banks and you people are going to come up with a B2C platform, or is it always going to be like that?
So if I think about kind of from a management team perspective, we all came from a B2B background. So when you come from a B2B background, B2B2C is easier than B2C. I think whilst you can understand the theory, there's just different aspects. I think we would need to change the team slightly to do that. So there's that side of it. There's another piece as well. B2C needs a lot of money. You need to raise a lot of capital. We raised a good slug of capital. We raised 80 crore, but that's not enough to kind of roll out a full B2C proposition. And
Absolutely.
part of it is how can you be capital light, reduce your customer acquisition costs and still grow? And the view that we took was, rather than us having to go find them, if they already have a demat account, if they already have a brokerage account, then they're a potential customer. So rather than trying to persuade people to come into the market and do that, actually, you know what? You've got a brokerage account. If you can access us through that, then that's kind of a great place to be.
Yeah, and then that's a smart strategy here. I think any which way, 80% of the business is going to come from this channel only. And the rest is all branding, as they say. But thanks a lot, Bruce, for your time. It was a pleasure chatting with you. The next time you're in Bangalore, please drop by. Do you travel to Bangalore?
I'm there about once a week. So I would,
We should definitely
I'll
chat.
make sure the next time I'm doing an overnight, I'll give you a shout and we can grab a beer in Bangalore.
Absolutely. Thanks a
Perfect.
lot
So
for this.
really enjoyed it. Loved it.